You just received $500,000, $1 million or more. Should you invest it all today or slowly move it into the market over the next several months? The wrong decision could leave you sitting in cash for years, but rushing in without a plan could cause you to panic the first time the market drops. This video is especially for someone who recently received or expects to receive $500,000 or more in an inheritance, a business sale, settlement, divorce, real estate sale, or another major windfall. I'm Tommy Cloud. I am president of Third Act Retirement Planning. I am also a certified financial planner and certified kingdom advisor. I help people who receive $500,000 or more in sudden wealth make wise financial decisions before taxes, family pressure, and rushed investing create costly mistakes. Here are 4 decisions to make before investing a lump sum. Decision number 1. Determine how much of the money is truly available to invest. Receiving $800,000 does not always mean you should invest $800,000. You may need money for taxes, estate expenses, debt, a home purchase, family needs, or several years of retirement spending. Your situation may depend on the type of asset, tax rules, deadlines, and your broader financial plan. Before investing, separate the money you may need from the money that can remain invested for years. Decision number 2. Do not confuse a phased plan with waiting for the perfect timing. A phased plan means investing set amounts on set dates. It's almost like a workout schedule. I'm going to the gym on Monday, Wednesday, and Friday at 7:30 in the morning, those days, and I will do these type of workouts. Market timing means waiting until the market looks safe, which is people have tried to do that a long time. And even the experts, I think that I have books behind me here on my shelves on trading. And I can tell you the top traders in the world brag about, at least historically, 55% win rates. You can't time the market. It is not something that can be done. That leads into a whole nother discussion of knowing valuations on the stock market. For example, right now the stock market's overvalued versus when it's undervalued, but that's not timing the market. But that deserves a different discussion. The problem is that the market rarely feels safe before it rises. When prices fall, people often wait because they are afraid. When prices rise, they wait because they think they missed their chance. Historically, investing a lump sum immediately has often beaten spreading it out because more of the money spends more time in the market, but historical results do not guarantee future returns. Decision number 3, choose a strategy you can actually follow during a market decline. Imagine investing $1 million today and seeing the account drop by $100,000 a few weeks later. Would you stay with the plan or sell everything? If investing all at once would cause you to panic, a structured phased approach may help you remain disciplined, but it needs rules. For example, you might invest a fixed amount each month on scheduled dates. You do not stop because of a scary headline, and you do not speed up because the market suddenly rises. The goal is not to predict the market. The goal is to prevent emotion from controlling the decision. And by the way, according to Vanguard and Russell, this is the number 1 value that a financial planner or wealth manager brings to their clients, is helping them to stay the course when the markets get rocky. Decision number 4, get the investment mix right before worrying about the entry date. The bigger risk may not be whether you invest Tuesday or 3 months from Tuesday. The bigger risk may be investing too much in stocks, taking risks you do not understand, paying high fees, or building a portfolio that does not support your retirement plan. Your goals, time frame, family obligations, and comfort with risk should help determine the mix of stocks, bonds, and cash, and alternatives, which could be precious metals, private equity, private credit, and other types of alternatives that you may want to put into your portfolio, even hedge fund or hedge fund mutual funds. So, should you invest a lump sum all at once? Possibly. Investing immediately may offer greater long-term growth potential. A phased plan may reduce short-term regret and make it easier for some people to stay invested. But neither strategy should begin until you know how much is available, what the money must accomplish, and how much risk you can handle. This is educational, not professional or personal financial, tax, or legal advice. You may need to coordinate with another professional in order to do that. If you receive $500,000 or more and you are not sure what to do next, apply for a sudden wealth planning session using the link in the description. On that call, we will walk through what you received, which decisions may be urgent, what tax or retirement issues may need your attention, and what your next step should be. This session is not for someone looking for a hot stock tip or a quick answer. It is for someone who wants a thoughtful plan before making major decisions with sudden wealth. We hope you enjoyed this edition of Sudden Wealth Stewardship, and subscribe, and we'll see you on the next edition of the Sudden Wealth Stewardship channel. God bless you.